So you've heard it before, when the markets become erratic or seem poised for a prolonged downturn, the best thing you can do is absolutely nothing. But if you're on the cusp of retirement, or perhaps even worse, newly retired, a turbulent stock market can make you feel particularly vulnerable. Joining me is Nicholas Stonnington with Prime Capital Investment Advisors in Pasadena, California. Nicholas, it's been said that market losses or corrections are actually worse for retirees. Why is that the case?
Has to do with the sequence of returns risk. So when someone's early in their career, for example, someone my age, if they lose money, they're going to continue working. They're going to keep making money and they'll have time to earn it back. Their investments can be very long-term in nature, since for the same reasons as mentioned before, if they go down in the short run, they have plenty of time to run them back up in the longer term. However, for someone who is newly retired, they're likely starting to take money out of their investments. So if they lose money in their investments, they're taking money out after their investments have dropped down substantially and they don't have the ability to recoup their losses.
So explain the concept of sequence of returns risk and why it's so important to consider in planning.
So there's no way of knowing when making an investment exactly what the return profile will be unless it's, for example, a government bond. As a result of that, we have to model what the investments may or may not do. And at the end of the day, these are simply models, they're projections. If you lose money early in the investment stage where you don't necessarily depend on the money, in other words, you don't have to sell the investment for any of your lifestyle needs or income needs, it doesn't really matter. I mean, it's not ideal, but you can receive the money back over time. Later in your investment life cycle, when you're starting to take out money, the problem is because you have to sell the money to produce the income needed to sustain your retirement, you don't have the ability to just let it ride out and increase the investment over time.
Nicholas, traditional safe money options have typically been bonds and CDs, but they aren't as attractive now. What other options are there?
I think that we have to analyze the client's profile to make sure that these strategies are suitable. But other areas that clients can typically find yield or yield-like returns would include real estate, whether it's a traditional REIT or a direct investment or maybe an investment into a series of real estate holdings. You can also use private credit. So typically these are higher interest rate loans that pay, several hundred basis points more than prevailing market rates for government bonds. And then in addition, we can use FIAs, fixed index annuities, which can provide bond-like returns with some enhancements for clients who match the suitability criteria.
My guest has been Nicholas Stonnington with Prime Capital Investment Advisors in Pasadena, California. Thank you for watching Retirement News Online.